Hello friends, welcome to today's session on important provisions related to interest on capital. In the previous video, we learnt about the concept of interest on capital and the reasons why it is allowed. Now, if you have not yet watched that video, please do watch the video to get the concept clarified. Now, as you know, that partnership is basically governed by the Indian Partnership Act of 1932. So the provisions given here would apply for all the partnership businesses. Now, you also know that the basis of partnership is the agreement amongst the partners. And when that agreement is put in writing, we call it as partnership deed. So when there is a deed, then as per the deed, whatever is agreement, according to that, the appropriations would be made or allowed. Now going into interest on capital and about understanding the different situations that you're likely to face and the accounting treatment that you're supposed to give in those different situations. So first, we will take up the situation where there is no partnership deed. Means they have not put it down in writing. There is no partnership deed available for that partnership business. Or they do have a partnership deed. They have created partnership deed, but when you go through that deed, nowhere do you find any agreement of on interest on capital. So they have not agreed to allow interest on capital in the deed. It is not present. Then what happens? So when there is either no partnership deed or the deed is silent, then under such circumstance, no interest is allowed on capital. Why? Because when there is no deed or the deed is silent as to interest on capital, the provisions that are given in the Indian Partnership Act of 1930. And when you refer to the Indian Partnership Act of 1932, it has clearly stated that if there is no agreement as to interest on capital or there is no deed, then no interest on capital is to be allowed to the partners. So even if they have varied amount of capital being contributed, still they will not be eligible. If a person has contributed more capital, he cannot come and claim, say that I have contributed more capital, I need to get interest on capital. No, because they have not agreed or there is nothing specified in the deed. Therefore, this situation, no interest on capital would be allowed to the partner. Now, moving on to the next situation. Situation 2 is when you have interest on capital where there's an agreement in the deed and they have specified that interest on capital is to be allowed at a particular percentage per annum. That's it. Then under such circumstance, you should know that under such circumstance, interest on capital is an appropriation of profit. And what is meant by appropriation? Appropriation is nothing but the division of the profit in different forms. The net profit, whatever is earned by the firm, is going to get divided amongst the partner in different forms. Some portion of it now is going to go to the partners in the form of interest on capital. Other appropriations, we do have like the remuneration which is paid to the partner. A certain portion of the profit might be set aside to general reserve, but whatever is left after all such appropriation is called as divisible or distributable profit, which will be divided in the profit sharing ratio of the amongst the partners. Therefore, when in the question, when you come across interest on capital is to be provided at a percentage per annum and there is no other term, then you should know that interest on capital is to be treated as an appropriation. Once that is clear that it is an appropriation, you know that you'll be putting it in the profit and loss appropriation account. Now you will be encountering different situations that we will discuss now. Like for example, the first situation is where there's a loss incurred during the year. Means the partnership firm on carrying on business during that year has ultimately incurred a loss during that year. So there is no net profit earned during the year, but there is a net loss which you have got from the profit and loss account from its operation during the year. Then what is the situation? Being an appropriation, if there is a loss during the year, then it is not possible to appropriate when there is no profit because there is a loss. So it is not allowed. Interest on capital will not be allowed when there's a loss during the year. Hope that is clear. The next situation that you can face is where you have profit before tax. So you have net profit during the year, and when you compare that profit before subtracting the interest on capital, you find that it is equal to or greater than interest on capital. Then what do you do? The situation here says, according to this, you would allow interest on capital at agreed rate. Now let us understand the situation with the example to get the concept clear. Suppose there are two partners. Let us take their two partners Amit and Sumit. These two partners have contributed capital, say rupees 2 lakh and rupees 1 lakh respectively. This is a capital contribution. Now suppose the interest on capital is to be provided on their capital at the rate of 10% per annum, and the profit for the year is suppose say rupees 40,000. Now first we will calculate the interest on capital, which would be for Amit being 10% of his capital, 2 lakh, that would be 20,000 rupees, and for Sumit it is 10% of 1 lakh capital, that would be 10,000 rupees. So total interest on capital to be appropriated from the net profit is rupees 30,000. Now here there is a profit of rupees 40,000. So your profit before you provided for this interest on capital of 30,000 is greater than the interest on capital. So therefore you can allow the interest on capital at the agreed rate, which means you can allow the entire 30,000 as interest on capital. So we allow the interest on capital of 30,000. Out of 40,000, 30,000 goes to the partner Amit and Sumit as 20 and 10,000 as interest on capital. So the balance what is left is called as divisible or the distributable profit. This would get divided amongst the partner in their profit sharing ratio. So whatever is the agreed ratio, in that this 10,000 rupees would get divided. So as per the situation, they have adequate profit to give the entire interest on capital. Therefore, you allow the entire interest on capital as has been agreed. Entire 30,000 is given. So that is the solution to the situation here, where profit before interest is equal to or greater than interest on capital. Now we'll go further. We'll see the third situation that you can enter. With the same example, we'll see the situation is when the profit before interest on capital is less than interest on capital. Same case we are taking Amit and Sumit. So we have already calculated. So we know interest on capital which they are entitled to is say 20,000 and 10,000 respectively. Now suppose the profit for the year is say rupees 15,000. Now you know the total interest on capital that they are entitled to is rupees 30,000. But you have profit for only 15. So your profit before interest 15,000 is lesser than the interest on capital as has been agreed at the rate of 10%. So now in this situation, how will you distribute? How would the appropriation of this net profit be done amongst Amit and Sumit? Now here the solution is you give the interest on capital in the ratio of interest on capital. You cannot give more than what you have. You have only 15,000. You cannot give 30,000 when you have just 15,000. Therefore, you will give this 15,000 to Amit and Sumit in the ratio of interest on capital. So here Amit has interest on capital of 20,000 and Sumit has interest on capital of 10,000. That is what they were entitled to as per the agreement as provided in the partnership deed. So find the ratio, it is 2:1. And therefore in this ratio of interest on capital, you would divide this 15,000. So Amit would get 2:1 means 2/3 of 15,000 and 1/3 of 15,000 would go to Sumit. So here it means Amit would get 10,000 as interest on capital and Sumit would get rupees 5,000 as interest on capital. So, although Amit and Sumit were entitled to, as per agreement, 20,000, 10,000 as interest on capital, as the profit was not adequate to cover the entire interest on capital, they are getting some amount, whatever is the net profit is divided among Amit and Sumit in the ratio of interest on capital. So this is a situation where the profit is inadequate and there is an appropriation of interest on capital which is more. So this is how the profit would get appropriated and the 15,000 gets divided. There is nothing else to be done because there is nothing else to be divided or appropriated after they have been given interest on capital. So that is the situation. I hope that is clear. Now moving on, there's one more situation that you might find in the question where they say interest on capital is to be provided at 10% to be treated as a charge. So this term charge is important. So now, so far what I told you was when nothing was specified and only interest on capital at the rate of certain percentage per annum was given, you assume that it's an appropriation and we saw the three situations how to treat it. But now in the question, when the term charge is there, you know interest on capital, you have to treat it as a charge, not as an appropriation. So when it is a charge, what does it mean? When it is charge, it means that you will allow it whether there is profit or loss. So even if there is a loss, interest on capital has to be allowed. Even if there is a profit which is adequate, okay, if it is an inadequate profit also, the entire amount of interest on capital has to be allowed. So same situation if you take, there is Amit and Sumit, they have interest on capital at 20,000 and 10,000, so 30,000. Now suppose they had a loss during the year of say 6,000. Then under such circumstance, this 30,000 will be allowed because they have said they have agreed in the deed that interest on capital is to be treated as charge. So what happens is that this is a loss before providing interest on capital. Now they provide interest on capital of 30,000. Therefore, the loss which is to be transferred to partners to their capital or current account would be 36,000. This 36,000 loss would be now distributed amongst Amit and Sumit in their profit sharing ratio. So this way the loss increases because interest on capital is a charge. Now suppose there is a profit, then to the extent if it is more than the interest on capital of 30,000, obviously you can allow it, there is no problem, and whatever is left would be distributed in the profit sharing ratio. But if it is inadequate profit situation, where suppose your profit is only 20,000, then what happens, you allow interest on capital of 30,000, then this profit of 20,000 will get converted to loss of 10,000 and this loss of 10,000 will have to be distributed amongst the partner in their profit sharing ratio. So therefore, when it is item of charge, it will go into the profit and loss account on the debit side like any other item of expense which is treated as a charge. This interest on capital also would be put into the profit and loss account and therefore profit could get converted to loss, and if there's a loss it could get increased further. If there's adequate profit, no problem, to the extent required you provide interest on capital and then whatever is left that would get transferred to appropriation account and then that would get distributed in the manner as has been agreed. So I hope this situation also is very clear to you. So now finally I would like to discuss with you the journal entry that you would be passing. Now there are two journal entries that you'll be passing. One for allowing interest on capital and another one is the transfer to appropriation account. So while reading the question, there's one more thing, like for one marker you might get questions where they say pass the journal entry for allowing interest on capital. Then under such circumstances you just have to pass the first entry, that is sufficient to get that one mark. You don't have to write the second entry as well. So for allowing interest on capital, the entry is You debit interest on capital account and credit the partner's capital or current account on the basis of the method of capital. If it is fluctuating capital, credit to capital account. If it is fixed method, you transfer the interest on capital to the current account. You're crediting it into the current capital account, and being an expense for the business or an appropriation which is to be given to the partner, you are debiting interest on capital. So this is the entry for allowing interest on capital. Now, after allowing interest on capital, now this account is there. That has to be closed down. Where do we transfer? In the closing entry, we are going to transfer it to appropriation account. So we debit profit and loss appropriation account and credit the interest on capital account. As you see here, you're debited, credited, and the interest on capital account is getting closed down. And this way you transfer it off to appropriation. So these are the two journal entries that you would be passing for recording interest, allowing interest on capital in the books of the firm. I hope this concept of interest on capital was clear to you. So if you found this video useful, please do like and share it. Please leave your valuable comments in the comment section below. It encourages me to create more creative content, useful contents for you. And if you have not yet subscribed to the channel, please do subscribe to the channel so that you will get continued notification of all my upcoming videos. So happy learning. Thank you.